Hello, hello. This is Coach McCarthy talking about taxes and personal finance. In point one, we talked about how to interpret a pay stub. We talked about FICA and all those kind of things. We talked about getting our check, and we talked about gross pay and net pay. Remember, gross is before deductions. Net is also known as your take home. That's after they've taken the deductions out of your gross. You get your take home. So today we talk about explain the nature of tax liabilities. So as always, you can click on the first one. It'll take you to a link here. And this will talk about tax liabilities. Some of these we're going to pull from, some of them I've already got marked. So we look at this. A tax liability is a tax debt you owe to a taxing authority, which is traditionally the IRS. That's the federal. And we talked about that you have state taxes you have to pay in certain states. Kentucky is definitely one of them. And some municipalities, and local places have their own tax. So, like I said, that comes up on because I live in Frankfurt, I have to pay a tax down there. When I lived in New York City, each of the boroughs has their own different tax. So you got to know what borough you live in and pay those taxes. Okay. So different places are a little bit different everywhere you go. So essentially, if you're paying taxes on it, it's tax liability. So, real simple, the nature of tax liabilities, any money you make, anything you have to pay taxes on is a tax liability. So your total tax liability is the amount of tax you owe from liabilities like income tax. Okay, that's our federal tax that we have to pay for working, our income. There's capital gains tax, which we're going to talk about, self employment tax, and penalties or interest. So, self employment, we're not going to get into too much. And you could have penalties or interest. If you didn't pay your taxes last year, you could have interest and penalties for not paying them, and those can roll over into the next year. So, you're still liable for those. All right. This also includes any past due taxes that you haven't paid from previous years. So that's what I was just talking about. All right. So when you get into this process, there's a few things you really got to know about. And letter B, you got to know your filing status. Okay. So I'm going to come to this link. This guy, Dave Ramsey, he's pretty good about talking about money and how it all works. So this is what we already talked about. And we talked about you got to know your tax liability. All right. You should have filled out your W 4 form with your employer. Right? And that's what's going to figure out how much you're going to claim if you have dependents and all that kind of stuff, and how much tax is going to be taken out. And this is talking about if you have a business, maybe you're having quarterly tax payments. Now, individuals can have quarterly tax payments also. We're going to talk about that when we talk about tax documents in our next little section. So, this is below or the federal income tax rate for the 2020 year. So this is where we talk about you got to know your status. Are you filing as single? All right. And it's just you, nobody else. Are you married, filing jointly? So you and your spouse are filing together. Are you married, filing separately? You're married, but I'm filing and your spouse. So me and my wife would file separately. We'd each file our own. We don't. We file jointly because we're together. Or you can file as head of household. All right. Now, as you start making money, they start taxing a little bit different. So your first, and on single, it's to 10,000 is 10%, then 12, 22. So these rates can change year to year. They stay pretty consistent and they might go up a point or two here and there. Probably not going to see a whole lot of fluctuation, but this is all above us. We don't control this. This is all set by the government. And they kind of explain this down here. Uh, so your first if you're single, your first $9,000 you make is taxed at 10%. Anything you make over that is taxed at a different rate. And if you were to go over 40,000 and get to this 40,126, that's taxed at a different rate. So the more money you make, the more tax you're going to pay. And we'll talk about 1044 when we talk about taxes tomorrow. And reducing your tax liability, you can make donations. That's a good way to try and bring down what you're going to have to pay taxes on. And when we do talk about filling out your taxes, we'll come back up in this one a little bit and talk about our deductions and what those looks like. So coming back to our thing, so the one thing we talk about, you got to know your filing status because you got to know if you're single or married or what it is, and then you got to know your income level. And we talked about why you got to know your income level because it's different at every different level. You're going to pay a different rate and a different amount. Different amount. So in I believe it was section 1, we talked about sources of income, and we talked about there's a lot of different sources of income and a lot of ways that you can get money and make money. Right? Any way that you're bringing money in, you have to pay a tax on it. Okay. Most of you guys are not old enough to be going to casinos and gambling. However, as you grow up, it might be something you're interested in. Well, you do have to pay taxes on those. Okay. And I can say this for a fact: if you go to the casino, if you win over a certain amount, and I believe this is what it is, it's 5,000. If you win over 5,000, they will take the taxes out before they even give you your money. So if you get lucky enough to hit a slot machine for $7,000, congratulations, they're taking taxes out of it. You're not going to get the whole 7,000. You're going to get whatever minus probably the 10%. So we'll just say 6,300. So if you win 4,999, you get it all. If you win 5,000, they're taking taxes out. Okay, so no, you do have to claim that. You have to pay taxes on it. Inheritance. I don't know if any of us. Hopefully, maybe one day one of you will get to the point where you're inheriting $11.58 million. I don't think I'm ever going to see that. But you do have to pay estate taxes on things you're going to be inheriting. And Kentucky does have an inheritance tax. So list of states here. This is from NerdWallet. And we'll get this site to open up here. We're going to scroll down, and this is kind of how the different estate taxes run. Which states have an estate tax? And oh, I'm sorry, we don't have an estate. We have an inheritance tax here in Kentucky. So not an estate, but an inheritance tax. So, so I apologize. We do not have an estate, as it says here. We have inheritance tax. And so, inheritance tax is a state tax on assets inherited from someone who died. Person who inherits the assets must pay the inheritance tax. As you can see, there's a couple states, and Kentucky is one of them, who receive inheritance according. So you have to pay that. All right, rules vary by state regarding the estate size and types, and what you're going to have to pay on and what you don't have to pay on. The one that they talk about here, it's a little rough. Maryland has both an estate and an inheritance tax. So if you get money, you might have to pay both the estate tax, and the inheritance tax, which would not be very good. Cryptocurrency, we talked about using Bitcoin and some other things like that. So those gains, so if you sell it for more money, that's 100% taxable as traditional regular income. So you have to claim that. And the last one that we talk about here is capital gains. So capital gains tax is a tax on the profit realized on the sale of a non-inventory asset. All right, that doesn't really mean just a whole lot to us probably right away, but the most common capital gains are realized from the sale of stocks. So if you make money in the stock market, you have to claim it, you have to pay taxes on it. Bonds, we've talked about, precious metals. The big ones that we see, real estate and property with our capital gains. If you buy a house and sell a house, if you buy it for 200,000 and sell it for 220, you made 20,000. Well, you got to pay taxes on that. It's not just you made money, congratulations. No. Do know that Uncle Sam always is going to get his money. So, nature of tax liabilities, know your filing status and know your income level, and make sure you're reporting all sources of income coming in.